The Volatility Index, or VIX, is frequently mischaracterized as a sentiment gauge or a fear index, implying it reflects the collective emotional state of market participants. In reality, the VIX is a mechanical output, a mathematical formula that reverse engineers the prices of S&P 500 options to determine what the market is paying for 30-day protection against price movement. It functions as a variance swap replication engine rather than a survey. The CBOE derives this number by harvesting prices from a wide strip of SPX and SPXW puts and calls. The calculation uses a weighting scheme where each option contributes to the total based on its strike price, specifically inversely proportional to the square of that strike price. By interpolating the variances of near-term options, 23 to 37 days from expiration, the formula produces a constant 30-day estimate. Taking the square root of this number and multiplying by 100 yields the printed ticker value. Before its inception in 1993, volatility was primarily backward-looking, calculated from historical data. The VIX shifted this paradigm, making volatility a forward-looking, tradable, and hedgeable asset based on current transaction prices for S&P 500 options. For the serious investor, the primary risk lies in two fundamental misconceptions. First, a low VIX does not equate to market safety. It merely indicates that options are currently inexpensive and liquidity providers are comfortable. Fragility often builds during these periods of complacency. Second, the VIX is not a directly tradable asset. One cannot buy the spot VIX. Exposure is only available through VIX futures, options, or ETPs, all of which are governed by distinct decay mechanics and roll costs. Treating these instruments as dollar-for-dollar proxies for the headline index is a structural error that often leads to significant capital loss even when a directional view on volatility is correct.
The integrity of the VIX relies on the architecture of execution, the continuous quoting of two-sided markets by market makers across dozens of strikes. The index uses the mid-quote, or the average of the bid and ask, as its fair value input. If a strike lacks a non-zero bid, it is excluded, making the VIX a real-time referendum on committed liquidity. This creates a volatility of volatility problem for the desks managing VIX futures and options, who must dynamically hedge using the underlying SPX complex. A critical structural feature is the weighting formula. Because contributions are weighted by 1 divided by the strike squared, deep out-of-the-money puts exert a disproportionate influence on the final number. When panic causes market makers to widen bid-ask spreads on these tail-risk hedges, the VIX can spike aggressively, even if the S&P 500 has not moved significantly. This is a structural friction, not an emotional overreaction. Institutional players further complicate this through vol-targeting strategies. Risk parity funds and trend followers are often programmatically required to reduce equity exposure as volatility rises. This creates a reflexive feedback loop. Rising volatility triggers systematic selling, which further depresses prices and increases volatility. Furthermore, the VIX futures curve usually sits in contango, where long-dated futures cost more than near-dated ones. This uncertainty premium allows short volatility strategies to harvest roll yield. However, when the curve flips into backwardation, these strategies face catastrophic risks. The 2018 Volmageddon event serves as the definitive case study, where the structural requirement for inverse ETPs to rebalance by buying VIX futures during a spike created a self-reinforcing collapse. This demonstrates that structural architecture can transform a standard market move into a systemic failure.
Beyond market mechanics, Federal Reserve policy serves as the primary external driver of the VIX. Expansionary monetary policy has been shown to decrease risk aversion with a lag of roughly 9 months, an effect that can persist for years. When the Fed provides ample liquidity, market-making desks operate with cheaper funding, leading to tighter bid-ask spreads and a mechanically lower VIX. Conversely, when the Fed drains liquidity or raises rates, the cost of balance sheet usage increases.
market makers widen their quotes to compensate, causing the VIX to drift higher regardless of economic fundamentals. This mechanical bridge extends to the real economy. A VIX spike reprices credit spreads and treasury duration, forcing cash market selling that is entirely independent of corporate fundamentals. For the long-term investor, the edge lies in recognizing the VIX as a mechanical byproduct of options plumbing, rather than an informational mood ring. The absolute level of the VIX is less instructive than its term structure, the relationship between spot VIX and its forward-dated counterparts, like the VIX 3M or VIX 6M. A flattening or inverted term structure signals that the market is pricing immediate concentrated stress. By identifying the players who are structurally forced to transact, such as vol-targeting funds or gamma-hedging market makers, an investor can distinguish between fundamental deterioration and a reflexive positioning unwind. Ultimately, the VIX measures the price of insurance in a system where the insurers are sometimes contractually forced to buy back their own policies at the peak of a crisis. Understanding these mechanics allows the professional investor to avoid becoming forced liquidity for another participant's rebalancing formula, turning a structural vulnerability into a calculated vantage point. The payoff is a more rigorous framework for assessing systemic risk and capital allocation.